There's a big difference between tax avoidance and tax evasion. The difference is jail. Yeah, so good evening, everyone. Appreciate y'all coming out. Such a beautiful evening. As John said, my name's Taylor Farr. I'm a commercial lender here in Bloomsburg with Journey Bank. For those that are unfamiliar or unacquainted, Journey Bank is a result of a merger, a relatively recent merger, between First Columbia Bank and Muncie Bank. So this took two long-standing community banks here in our footprint, everywhere from Columbia, Montour, Northumberland, Luzerne, Lycoming, Clinton counties, and merge them together. And of course, if you take two long-standing community banks with long-standing traditions, it comes down to whose name are we taking? And at first we tried Muncie Columbia, and that does not roll off the tongue. So as a result of a nice high-paid consultant, our marketing director, who received none of that consultant's fees, came up with Journey Bank. In fact, interesting statistic about that, 70% of all banks have the names People's Security Trust within their name. So to come up with Journey Bank and have it not be taken was like a needle in a haystack. So we are here for your financial journey, and hopefully I can tell you a little bit about commercial financing, growing your real estate investment portfolio here this evening. Again, my name is Taylor Farr, commercial lender. Just to give you a little background, been with the bank for 15 years. Do all types of commercial financing. We'll talk a little bit about what that includes. What is commercial lending? All types, okay? Buy and hold, that's your rentals, long-term, short-term, medium-term rentals. The BRRRR process is going to typically fall under commercial. Fix and flip, commercial real estate, just like the property we're sitting in right now. You know, mixed use, anything from Dollar Generals, warehouses, self-storage units, you name it. Commercial real estate. Construction, ground-up construction could be any of those varieties as well. Could be townhomes, could be spec homes, could be apartment buildings, commercial, again, you name it, I've probably done it. Land subdivision, same thing, buy a large parcel, some of the parts worth more than the whole. Agricultural, do a lot of farm lending. Jeremiah, I know you work with the local farmers, so you can probably speak a little bit to that even more so than I. Commercial lending can be done in a variety of ways. It can be done to you and your individual name. It can be an LLC. Could be a corporation. If it's under an LLC or corporation, automatically flows over to me. And I'll use that as a segue to some of our financing options. Because again, I get a lot of questions from first-time investors. You know, buying a duplex, you know, how can I finance this? A lot of people come to me for their first investment saying, hey, I bought my house. How does this compare to the commercial side? There's a lot of similarities. There's a lot of parallels, but there's also some key or core differences to keep in mind. Again, this is very simplistic, residential versus commercial, but one of the biggest differences is a lot of people, you know, you hear 30-year fixed rate residential conventional mortgage, Fannie Mae, Freddie Mac, VA loans, FHA loans, you name it. Those are your standard conventional residential loans. Basically, when I have this initial conversation, I'm having the conversation with the first-time investor to say, residential piece, you might have 6 sandboxes sitting on a playground. You either fit in one of those sandboxes or you ain't playing in that sandbox. Again, Fannie Mae, Freddie Mac, USDA, rural housing, you name it, that's your sandbox, very rigid, high sides. On the commercial side, I'm going to build my sandbox to fit you, your situation, and your scenario. Okay. Other situations to make by comparison terms, again, typically on the commercial side, 20-year term versus a 30-year term. Balloon payments, you typically don't see those on the residential side. Variable rates versus fixed rates. Again, we'll talk more about rates later, but rate structure-wise, on the commercial side, I'm typically looking at a 5-year adjustable. Now, a lot of folks might say adjustable rates, dig their heels in, lean back and say, no way do I want an adjustable rate mortgage. That's what caused the financial crisis, or I don't want my payments to jump up and bite me in the butt later on. Adjustable rates can be concerning. I mean, for instance, if you took a loan out in early 2020 and you had a floating rate, yeah, that's going to bite you now because prime rate's up at 8.5%, and rates as a whole are up across the board. But if you're an investment property, if you're an investment REI person here in the room, those adjustable rates tend to adjust with inflation. Now, again, we're in a very unique environment right now because inflation has driven rates much higher, much faster, at a pace greater at any other point in time in history. But take a conventional, more normalized environment. As rates increase over a 5-year period, guess what else is going up? Your rents. So typically that's a compensating factor, okay? Wealth creation with real estate. Everybody here in this room as a real estate investor is focused on the wealth creation. When I have a conversation with first-time investors, is that there's 3.5 ways to build wealth with real estate. Equity, capital appreciation, cash flow, and that half piece is taxes, okay? Again, is there anybody in the room that's not familiar with those components? I didn't think so. I thought everybody might be familiar with those. But equity, of course, the difference between market value, the principal balance in your loan, every month you're building equity. You're creating wealth that way. Appreciation, again, the difference between the price paid at acquisition, current price, cash flow, and taxes. Real estate is one of the most tax-advantaged industries or assets there is, okay? With that said, looking at our local market, and is everybody here from our local market?
We have Shamokin, which is, I guess, local.
We have Shamokin, yeah. So yeah, Justin, we were talking about that a little bit before the presentation started here. Shamokin's a unique market, I would say, for REI, okay? A lot of markets here in Bloomsburg, the closer surrounding areas, Berwick, Danville, et cetera, the main components for a real estate investor here locally are these two right here, equity and appreciation. Cash flow, you're going to get it, but it's not the main piece of the pie, okay? I would say Shamokin, the coal region market, if you will, flips that on its head. You're going to get equity built. It's just that your equity, you're going to buy a half double for. What would you say half double is in Shamokin these days? They did shoot up considerably during COVID the last couple of years.
Probably 20 to 30.
Yeah, so you can buy, you can trade in your car and buy, a duplex, down in
The
Shamokin.
rents are roughly $800 to $1,000 a month.
Correct. So you're getting the same market rents. So your equity, you're going to be capped out of what you could realistically get. And assuming things continue to do well and advance down there, which again, Justin is, you said the city manager for, what'd I do there, John? Pull down.
Yep.
With the current tourism from the adventure,
Unable to connect.
the outdoor park is beneficial.
Yeah, so that's
I haven't seen this one yet.
oh, there we go. Back at her. So, the coal region is a good example that's more cash flow centric. Airbnb, short-term rentals, those tend to be more cash flow centric as opposed to equity or appreciation as well. And short-term rentals also mitigate some of the tax advantages too. But again, I certainly encourage you to consult, when you're in business, all those sources of input, insight. When you're in business, you want to have a good, strong attorney, a good, strong accountant. In real estate, you want to have a good, strong realtor. And I'll always put a plug in there and say a good, strong banker as well. I think we're disconnecting here, John.
Yeah, looks like it, huh?
All right. My core focus here tonight was to talk to the group about underwriting process. Again, a lot of times when somebody's analyzing a deal, you can analyze the deal till you're blue in the face. The biggest thing about REI, real estate investing, is to not be emotional, right? The numbers don't lie, emotions do. You don't want to get caught up in those emotions. From a lender standpoint, we examine a number of items, all of which fall under what's called the 5 C's of credit. Character, capacity, collateral, capital, conditions. Character is going to encompass a number of things. That's primarily credit score. Okay, we do look at credit score. Capacity is your debt to income, debt coverage ratio. That's where we do look at the cash flow for you personally, as well as the property. That's the debt coverage ratio. I want to make sure that your personal DTI is not wildly out of line. I want to make sure that you don't have to buy this property, the cash flow. Your your personal living expenses. Collateral, you can see I didn't put a dash there. That's pretty well self-explanatory. I got to have something to lend against. Capital, that's your equity or cash available. I'll explain that one a little bit further because that's a key point, especially for beginning investors. Okay, and scaling your portfolio as well. Conditions, how is the money going to be used? Okay, if you come in and tell me I'm looking to buy a rental property and you go out and buy a Corvette with it, that kind of ties right back to character as well. Okay, credit score goes in the character, but if I say, I seem a little bit of a dodgy character there, Brian, I don't know if I want to lend to you. Okay, as well as the external environment, things like interest rates, or are you looking to put $200,000 into a half double in Shamokin? That might not be the savviest investment move. We want to make sure that things are sensible. The capital piece, I'm going to pause there and talk a little bit about equity or cash. Okay, conventional commercial financing structure for residential, that's 1 to 4 family, that's apartment buildings, anything fully residential. John, maybe you could talk about Greystone. That's one of your properties, 42 units, all residential. That's an 80%, even though it's 42 units, I can lend up to 80% loan to value on something like that. Something like this, a mixed-use commercial property, I'm at 75%. Now that 20 or 25% down can be cash, could be equity. So to use simple 6:30 p.m. numbers here, let's say it's $1 million project. Okay, you got $1 million project, and let's say it's an apartment complex, 10-unit property. I could do that $800,000 loan, and you come to the closing table with $200,000 plus closing cost. Or let's say you already own a small portfolio of properties, okay, and you have equity in each one of those properties. And again, you might need a notepad for this one. I'm going to try and convey it, but let's say you have 4 properties. Each of them have a little bit of debt, and let's say all 4 of those properties are worth $200,000 a piece. Okay, you have $800,000 of equity, but I margin that equity again at 80%. So $800,000 is what I call loanable or lienable equity of $640,000. Okay, it's the 80% of the 800. If you have debt of 400, you have $240,000 of usable equity. Going back to the $1 million acquisition, I can finance your full $1 million acquisition with a $1 million loan secured by purchase property and then what's called junior liens on properties A, B, C, and D. Okay, so it's called a blanket loan, a portfolio loan, and that's how a lot of people will scale their portfolios. Okay, if you're looking at people that built massive portfolios, they probably didn't do it 20% cash at a time. Okay, they did it through the power of leverage. Leverage is your friend. And I'll talk a little bit more about leverage here in a minute. But as I look at that same example, I do what's called a rent roll analysis. This is one of the spreadsheets that I sent to John that's on the QR code there. It's a very simple, quick and dirty analysis, okay? And I put this out to any one of my clients, any of my prospects, anyone in this room, that as you look at rental properties, call me, text me, email me, and say, hey, here's a property that I'm looking at. Here's the rents, here's the expenses, here's what I'm looking to offer. Or maybe you don't have an offer price. I can utilize this tool, this spreadsheet, take 3 minutes and give you a thumbs up or a thumbs down, okay? I don't know if it's visible from the back of the room or even from the front of the room, really, but when I utilize this spreadsheet, I use annualized and rounded figures. So if I'm doing a refinance, you can see I'll do a trended analysis, 21, 22, 23, and then projected. For a purchase, you don't have historical rents to go off of. I'm going to do the projected column here. But let's take who has an existing rental property they want to use for an example here? I'd be happy to run through the numbers. Anyone want to volunteer some information?
What does the bills?
Yeah. I won't put anybody on the spot. Let's do a hypothetical. Let's say you're buying a duplex in town. And the way I'm going to broach this is, let's say you're looking at a duplex and you want to know, Taylor, how much can I offer on this property?
Why don't we do Glen Avenue?
Glen Avenue, perfect. Throw some numbers at me here, John.
So $980,000 purchase,
Yep.
16 units, rent roll is $18,600 a month.
Okay, I'm going to need a calculator. So I'm going to take the $18,600 a month. That's your rent roll on 16 units. So I use, again, rounded, annualized figures. So this top cell here, that says gross rental receipts, I'm going to put in 223. It's 223,200 is your annualized rents. Now, we also, to be conservative, we take out a vacancy factor and a maintenance reserve, because as nice as it is to have a fully occupied property, to be maintenance-free, that's not reality. Okay? You're going to have tenant turnover. You're going to have collection vacancy. You might have all 16 units occupied, but you might not be getting a check next month because the tenant's not paying you. That's a collection vacancy. So I take 10% of the 223, again, rounded, so it's just a 22. So I take out 22,000 for vacancy, 22,000 for maintenance. So again, 44,000 right off the top. So I take 223 minus 44, I'm left with 179. From there, I'm going to back out your taxes, your insurance, any landlord utilities, your operating expenses. You got a number for me there, John, ballpark?
As far as the operating expenses?
Operating expenses, yep.
Yeah, so per month we are at $5,400 a month in operating expenses.
So 5,400 a month is 64.8. That rounds up to a 65. So I'm going to take 179 minus 65. It's 114. It's called NOI, net operating income. Okay, that NOI is what you have left after all expenses, vacancies, maintenance, reserve, etc., to cover your debt. I'm looking for a debt coverage ratio, and a lot of people probably say, it's DCR or DSCR, they're one and the same. Debt service coverage ratio, debt coverage ratio, all one and the same. DCR, I'm looking for every dollar in debt to be covered 1.2 times, okay? Different institutions will have different DCR requirements. At Journey Bank, we're looking for 1.20 for most residential components, okay? So then I'm gonna back into this, I'm gonna say, okay, that 114 NOI, how much debt can I cover to hit that 1.20? And that's $95,000. So then I don't have my financial calculator with me, but I do have an app to do the same thing. And I say, okay, what's $95,000, okay, in debt? What is that mortgage amount? And I take prevailing interest rates right now over a 20-year term, I plug in a rate, and then I'm going to plug in loan amounts. And you said 980 is your purchase price, John. So I'm going to start with 980, okay? I'm going to say if you have 980,000, let's assume John has equity that he wants to put towards this transaction. Can I finance the 980,000? 980,000, current interest rates, 20-year term, those payments are going to be about $7,900 a month, which is $95,000 a year. So John, that property, what that says is that $980,000 is a slam dunk.
Yeah, it's also a foreclosure.
Yeah. So that's an example of using equity. It's an example of a strong cash flowing opportunity. To let you know on a little secret, when I'm looking at properties, I can establish rules of thumb for most markets. Like here in Bloomsburg, if you say, I'm looking at a duplex, here's the rents, I can usually say within reason, I can get you within $25,000 of what your price should be. Now, that's not to say that that's what the property is worth. Interest rates are the elephant in the room. Okay, and for anybody that's ever been in my office, I have a little wooden elephant sitting on my desk, and his name is interest rates because he's the elephant in the room. It's, rates are a driving factor right now. Like a duplex again. Oh, shoot, John.
So just put 04 2193.
Thank you. So again, interest rates are a driving factor for valuations right now. You'll hear things like cap rates, et cetera. When you're looking at residential real estate in our market and from a financing perspective, I as a banker, I gotta be honest, I'm not looking at cap rates. You can say, oh, this is a 10 cap, a 12 cap, a 6 cap. That's great. I'm not saying it doesn't mean anything to me. It does. Appraisers will look at cap rates for arriving at valuations. I as a banker, I don't care what your cap rate is, I care what your DCR is.
So
Okay.
to add to what Taylor is saying, so back in December, there was a portfolio for sale off market that we purchased, this would have been through the keywords. I think it was $825,000, so we purchased it for, and the seller came to me and said, here are my rental properties, what will you pay? And he sat with me upstairs in my office, and we ran the spreadsheet together, and I said, I'm looking for a 1.2 DSCR. And the number that we got on a 1.2 was basically 825, and I took it to Taylor and said, your sheet makes sense, my sheet matches it, and we had a deal under wraps and closed in 3 weeks.
Yeah.
Based on the spreadsheet.
Yeah. Yeah, like I said, this is a quick and dirty tool. I mean, I'm sure there's many people in the room that have their own spreadsheets they use. I encourage you to use them. If you have a methodology that works for you, utilize it. Like I said, the key variances that I typically see between my quick and dirty analysis and an investor's or a realtor's analysis is the vacancy and maintenance factors. Like I said, I use 10%. And yes, that may be overly cautious or overly conservative. You might say, well, I have a 5% vacancy factor in my portfolio. Well, that's understood, you know, and for some people I can get a little creative there. Maintenance reserves, same thing. You might say, well, I do all my own work, right? Again, super, but do you do your own roof? Do you do everything? At some point in time, you know, there's going to come a time, I'm looking at you, Jared, but the time's going to come where you might need to replace a roof, you know? And, you know, for example, in this 16-unit scenario, you know, if you have to replace 4 roofs, you know, I have $22,000 budgeted, and it might be 40. You know, and you just used up 2 years worth of maintenance reserve in 1 year just replacing roofs. Now, hopefully that lasts the next 20 years. But again, that's the key component here. I'm using 10% because I'm making a 20-year commitment to you, okay, and you're making a 20-year commitment to this loan. As such, over the course of that 20-year commitment, you're probably going to have a roof replacement or a major capital expenditure. So yes, conservative, but again, we don't get emotional about real estate. We look at the numbers. So putting it kind of together here for a first investment, who here is looking to purchase their first investment? Perfect, yeah. And who here in the room already has some investment properties under their belt? Awesome, all right. So we'll talk about putting it together, but then we'll also segue into scaling a portfolio. The first property is intimidating. It doesn't have to be hard. Okay, so I kind of talked a little bit about leveraging equity. So again, it might be intimidating when you're looking at a duplex for $150,000. You say, where the heck am I going to come up with 30 grand, especially just graduating college? That's where we talk about leverage. Okay, to expand, especially for you guys are in college, right? So I'll talk a little bit, you know, as younger folks build it, you know, coming out of college with student loans, car payments, credit cards, etc. It is tough to save, especially in today's economic environment. I'll expand a little bit just for you guys for the first investment. Leveraging equity versus cash, it doesn't have to be your own property, okay? I've done situations where it's a young person buying their first rental property and mom and dad step up to the plate and say, hey, we want to help out, you know, our son, our daughter, you know, our grandson, our granddaughter, our niece, our nephew, okay? And maybe this is a conversation, too, to talk to the rest of the crew for people that are looking to get their kids or grandkids, nieces, nephews started in real estate investment. So if you or your parents have equity and they say, you know what, we want to help you along. I've done situations where you say, the debt is in Jeremiah's name, okay? But we can have a conversation and say, Jeremiah, you seem like a hell of a guy. Let me pledge my farm as collateral for you to get started on your investment journey, okay? Again, my asset, my farm is on the line. You're the one making the payments, okay? So we do the whole debt coverage ratio scenario. We run your personal credit, and I just say my farm is worth X. I only owe Y. I have equity of Z. That's going to provide your 20% down payment. What I'm saying is if Jeremiah does not make his payments, my asset's at risk. Okay, the bank can come after not only Jeremiah's asset, the primary collateral, but also Taylor's, okay, who pledged it on his behalf. So that's a great way to get started. I mean, you can have, again, it could be other real estate. I can lend on real estate. I can lend on investment portfolios. Caveat to that has to be non-retirement assets. I cannot lend on IRAs, 401s, 403s, 457s, etc. Okay. Review cash flow, cash flow, cash flow, cash flow. As I mentioned earlier, those 5 C's, probably the biggest ones are cash flow, capital, collateral. Okay, they're all important, but if I had to rank them, that's how I'd rank them. Okay, so keep your credit in check. You know, a lot of young folks or people looking to get their first investment property. They're coming out and saying, well, I went out as soon as I graduated and bought a new car. You know, so I have a car payment of $700 a month. That's the national average monthly car payment, by the way, is over $700 a month. Keep your credit in check, okay? Keep your cash flow. Again, let me run the numbers, okay? Let's sit down and run the numbers together on the property. We want to make sure it cash flows. Again, no emotion, only the numbers in real estate. Scaling a portfolio. Build your cash flow, build your equity, build your portfolio. As I said, if you sit around trying to save your 20%, purse to buy the next property, it's going to take you a long time to keep scaling. But building equity, and that can come in a lot of ways. For those that have been in the real estate game for some time, building equity doesn't have to come from putting new paint, new floors. It can come through improving cash flow. We can always go back in, reappraise the property, re-leverage that equity. So to use that as an example, let's say you bought a duplex back in 2015, okay? Before all the market appreciation of COVID drove prices up. And let's say you paid $90,000 for it. You haven't done much to it, but when you bought it, rents were $600 a month, okay? Nowadays, they're $1,000 a month. It's $800 a month increase in that property. When we take that into consideration, we go back with the property reappraised, we only paid $90 for it. Again, going back to the equity, capital appreciation, cash flow components. Your equity has gone up, now we get it reappraised and it's worth $160,000. Let's use that equity. Or let's say you just bought a property, okay? Maybe it was a 4-unit property, it's a little rough around the edges. You're going in, you're fixing it up, you're getting the rents up to market rents. Buy it for X, get all the renovations done, get the rents, get it fully occupied. We go back in a year later. This is the BRRRR process, by the way, for those unfamiliar. And then we do a refinance, cash out. Now you got the cash to roll into the next one, okay? There you go. You've done the BRRRR process? Yeah. So we got the cash flow, equity, build your portfolio. Again, equity and leverage is your friend. Don't over leverage when you're trying to scale your portfolio, okay? Over leverage can be just as deadly as under leverage, quite frankly. If you're trying to grow a portfolio with just cash, it's going to take you a long time. But if you over leverage, it's also going to kill you, okay? Because again, interest rates, unfortunately, we don't do fixed rates in the commercial side. If you over leverage, I'm looking at the map, the roadmap ahead for all the folks that bought in 2020, and 2025 can be a bloodbath, okay? I think there's going to be a lot of opportunity in front of us in 2025, 2026, 2027, because there was a lot of people rushed in buying properties when rates were at 4%. When those rates adjust, unless they've been paying attention, getting rents up, taking care of things, keeping their cash flow in check, when their rates adjust, a 2% swing, depending on the size of that property, there's going to be properties on the market. There's going to be people taking haircuts, okay? Keep your eyes open, okay? Look ahead. To that extent, I tell folks, if you're buying a property right now,
It's gonna work in 5 years.
if it works at 8% interest rates, it's sure as hell going to work at 5%, okay? And again, we're going to talk more about interest rates here in a minute. I think it's going to be a dynamic part of the conversation. The other important part about scaling a portfolio, report your cash flow, okay? I come from a small business background. I know there's a lot of people in small business. Cash is king, right? That's great. But when you either pay Uncle Sam or you borrow and scale your portfolio. You can't do one or the other. If you're saving on taxes by not reporting cash rents, that's a big no-no, by the way. That's tax evasion. There's a big difference between tax avoidance and tax evasion. The difference is jail. Okay? So report your cash flow, because if you don't have the cash flow reported, I can't lend to you, whether it's a cash out refinance, whether it's continuing to grow and scale your portfolio. Any questions on scaling portfolio or buying your first rental property, by the way, before we kind of segue into talk about rates?
The only question that I guess I have is if you were to evaluate the entire value of my portfolio and I were to do a blanket loan, okay, so if I default on that blanket loan, I'm going to lose my entire portfolio.
Correct.
Yeah, so as awesome as that sounds. You call me.
Yeah.
So as awesome as it is to do blanket loans, I see the value in that, but that's also, if you're not good with the money, super risky at the same time.
Well, yes and no. It's blanket loans, they enable scale. It doesn't have to be a blanket loan where you're encompassing. I use blanket loans one of two ways. One, it might be piecemealing collateral or equity in other properties to acquire the next property. But you might say, I have this entire portfolio and things are stabilized. I'm done growing. You might say, I've reached my goal number of units or my goal cash flow, but for simplicity's sake, instead of me having 16 mortgage payments, let's wrap this all into one. and you're stabilized, maybe you're on, cruise control, you got a property manager in place, and you say, I just want to sit back, collect my checks, and call it a day. That's when we can wrap it all together into a portfolio. Those are the two times I typically use blanket loans or portfolio loans. Yeah. Other questions? All right.
How do you treat the seller holding the second mortgage?
So that's a great question. All right. So I didn't talk too much about the collateral piece. So again, 80-20 for residential is what we typically, that's the conventional norm, right? As a bank, we'd like to see some skin in the game. Okay, so seller financing can count towards that 20%. Now, I usually don't like to get into 100% leverage deals where it's bank with 80%, seller with 20%, because it's pretty easy to walk away. If we were in that same situation back in 08, 09, and I'm 100% leverage between us and the seller, you have no skin in the game. When things go south, you just walk away from the property, right? Like, what'd you lose? You didn't put anything into it. So we usually like to see 5-10% down, cash or equity, that something's contributed. And then we can do that seller financing. That seller financing piece from a cash flow perspective, I still have to count those payments in my calculation for a DCR. Okay, so I would have my debt component and the seller financing component to calculate that debt coverage ratio. Great question, Mary. Thanks for asking.
We were able to close on our 42 unit with, am I allowed to tell them this?
Yeah.
Okay, so.
Your information.
So we were.
Share away.
So we bought a 42 unit for $3 million, me and Jared and a couple other partners. And we got the seller to give us a 10% finance, with, so the 5-year balloon that we have. And, we were able to basically bring 300 grand to the table at closing 42 unit, and we're still on pace for cash flowing starting in July of $20,000 a month. After mortgages, after all expenses, taxes set aside, and so on. So that was a smoking good deal too. That was the first finance deal that we did where a bank actually considered the seller finance aspect as part of our down payment. That was pretty awesome.
Yeah. Yeah. But as John said, there was still some skin in the game in that one as well. But other questions? I'm looking to make it more Q&A before we start talking about rates. I can't just cover everything, but I can cover questions with answers.
Rates did not go up today if anybody watches the Fed, so they're staying steady.
Yep.
So, yeah, it's good.
I would assume it would be the bank's policy not to look for skin in the game. That was the way I was able to get started when I started way back. I was seller held the first 20, 25% actually, and I received a 70% first mortgage. And without that 5 unit, I would have gone, it didn't take a whole lot for equity to build up in that.
Right.
And once the equity was built up, which was within 5 years, less than 5 years, it was built in less than 3 years, I was able to refinance it and pay off.
Yes, so that's,
the other one.
yep, so I'll talk about those types of scenarios. As John said, as Mary just said, a lot of times with the seller financing, there's a balloon payment where it comes due. Yep. So again, my loans on the commercial side, while they're adjustable rates, they're not balloon payments. That's a key factor to keep in mind. As a community bank, we're here to work with you, not against you. I'm not going to throw names out there, but the big banks, the mega banks, keep an eye out. Make sure you're comparing apples to apples, not apples and oranges, because a lot of times they might say, here's our 5-year rate, and you're thinking, what Taylor offered me, a 5-year rate. Well, they'll offer you the same payments, maybe even a lower rate, but that's going to be a 20-year amortization, 5-year term, a balloon payment, just like the seller financing pieces. And that's where you get in trouble. That's where they'll say, Jared, we like you now. Here's a, below market rate, 20-year amortization. You're going to make your payments like it's a 20-year loan, but we're going to get to year 5, and then we're going to reevaluate you, okay? And we still like you. Let's get another appraisal, by the way. Pay me an origination fee, okay, or a point. And we're going to extend this another 5 years, where we'll do it again until this loan's paid off. Or, worst case scenario, they'll say, Jared, we don't like you anymore. Pay us off.
That happens a lot.
Yeah. I don't know why, Jared. But that's the other piece, and that's what we saw a lot of during the financial crisis, was not so much adjustable rates. Adjustable rates, when the financial crisis hit back in 07, 08, 09, rates were actually on a downswing. So adjustable rates were not the issue. It was balloon payments. There's a lot of the no document loans, people just getting loans with no incomes, ninja loans they call them, no income, no job applications, ninja loans. The subprime market blew up, as a result. but balloon payments are more problematic. Now, from a seller financing piece, we can look at, and I've done this for folks where I say, here's where you're going to be on track with your seller financing piece when it's set to balloon in year 5. Here's where you're going to be with my loan in year 5. And as long as your property keeps and maintains the same value or appreciates at 1.5%, 2%, this is the value we need. And then assuming your cash flow is X, Y, Z, I'll do that same cash flow analysis, say in 5 years, here's where we're going to be, okay? Tying this back to the earlier conversation, if you're buying properties now with higher interest rates, you're really lucky, okay? You're lucky to be buying properties now. I'd rather buy in a high interest rate environment than a low interest rate environment because of adjustable rates, okay?
That and lower rates will hopefully push appreciation up as well.
Correct. Yeah, lower interest. So that's a key factor too. When going back to this spreadsheet here, when I'm looking at these properties, like I said, I can use it kind of as a gauge to say, this is what your property can support. Now, as investors in this room, what are you willing to pay for an investment property? Take the number of units, take the, all that stuff, and throw it out the window. What are you willing to pay for a property, an investment property? What are cash flows, right? If it cash flows, if it's $1 million property and it cash flows, all the expenses, the debt, the vacancy factor, the maintenance reserve, you'll pay $1 million. You don't care if it's a duplex. If that duplex is generating $7,000 a month per side, you'll pay $1 million for that duplex. There's duplexes in California, San Francisco that sell for $1 million. There's duplexes in Bloomsburg that sell for 150. It's what it cash flows. So as rates come down, intrinsically, theoretically, I should say, the values of property should appreciate. So going back now to the rate conversation. Correct. COVID, the reason for real estate capital appreciation primarily was low interest rates. Just like we're seeing now, real estate prices supposed to be coming down. That's the Fed's anticipation, is that high interest rates will suppress the price that people are willing to pay. This ties into a lot of conversations about rates, which we'll segue into now. I just have 2 links here, but I'm just going to throw out personal opinions. This in no way represents Journey Bank's opinions on rates. This is Taylor Farr's opinions on rates, by the way. But interest rates in the real estate market, again, we've seen 7-8% interest rates, mortgage rates right now, and it's not tamping values down. So what's going to happen when rates do come down? Are the prices going to continue to appreciate? Again, going back to the multifamily investment property piece, I think that will continue to see marginal improvement in values as rates come down. But I also think, at least for our localized area, by and large, rents are pretty well stable near term. And I think a lot of people in this room would probably nod in agreement to that, at least for the foreseeable future. Single family properties, though, again, I'm not an expert on this. I'm not an appraiser. I'm not a long-time, realtor. Again, just personal opinion is I think we're probably in for some sideways pricing for the next couple of years, because as rates come down, I don't think you can see a conventional cookie-cutter home in a subdivision here in Columbia County go up another 10, 15% in the next couple of years as a result of lower rates. So those are some factors at play. To talk a little bit more about rates, if I click on this, John, does it take me to my... Do I have to longhorn?
Might not, because it's stuck in the PowerPoint.
Well, anyways, these links will take you to the CNBC and HSH.com. The CNBC would take you to the chart for the 10-year U.S. Treasury. And if you looked at that, for the last year, it's been like this, straight up. Okay, not quite straight up, but we've seen a huge swing from February 1st to the end of April. We've seen almost a full percentage point increase in the 5-year and 10-year U.S. Treasuries. Okay, the 10-year U.S. Treasury, by the way, is what most 30-year fixed-rate mortgages are priced upon. So when the general prevailing assumption is, well, rates are going to come down, rates are coming down, right? The exact opposite. Rates are going up. And while the Fed came out today and said they're holding rates steady, okay, there was some rumblings, some musings that the Fed might actually increase rates because they're still 1.5% or more above their target inflation rate of 2%. It's not, again, higher interest rates are not having the impact. So they might increase rates even further. They came out today saying they're holding steady, just higher for longer is what you're going to hear, higher for longer. They're going to keep these elevated rates for the time being. We went at the start of the year from having expectations of 6 rate cuts in 2024 to 3 rate cuts to probably none at all until 2025. Okay. Again, I don't hold a crystal ball, I hold an iPad, but I can't predict the future. Okay. Similarly, the Wall Street prime rate. Okay, the second link takes you to a chart that shows what the U.S. Wall Street Journal prime rate has done over the last year and a half. We saw 11 rate hikes over a 16-month period, the most rate hikes ever for Wall Street prime. Some of those rate hikes were 75 basis points, 3/4 of a percentage point. We went from 3.25% at the beginning of 2022. Right now, Wall Street prime rate is 8.5%. Prime rate drives auto loan rates, it drives credit card rates, it drives line of credit rates, HELOC rates, drives all those. So as you say, hey, our rates are super high, what the hell's going on? That's what's going on. Wall Street prime, US Treasury bills, they drive a bank's funding structure, okay? Not to nerd out or talk too much economics here, but banks are in a challenging position too, just as real estate investors are. You think it's difficult to find a deal that works in these interest rates? Try and fund the deals as a bank, all right? At the most simplistic, banks, we make our money by bringing your deposits in and then lending it out. We might lend you at a rate of 8%, just as an arbitrary rate on a mortgage, but we're paying our depositors 5%, okay? That's our spread, okay, 3%. That's our margin. That's what's got to pay my salary. So it's got to pay the light bill. It's what's got to pave the parking lots, pay the garbage bill. 3% is not a very big number, okay? And that's realistically in this environment, that's an idealistic 3% spread. Gross margin. Right now, to borrow money from the Federal Home Loan Bank, which is what many banks are doing, you're paying about 5.6%. So if I'm lending money at 7.5%, we're making 1.9% on that loan. Gross margin. So it's a very challenging environment. So to just throw some tips and tricks, if you're looking to establish a lending or a borrowing relationship, with whether it's with Journey Bank or any bank for that matter, they're going to want your deposit relationship too. Okay, that's key. That is cornerstone for building a lending relationship. Banks want the full relationship to begin with. Okay, they want the lending relationship, they want the deposit relationship, they want your merchant services if you're a merchant, etc. That's key cornerstone to it all. Anyone else have any musings or questions on rates?
I have a comment to make. I've been around a long time, and my first 5 unit was 18% interest.
Yeah.
So that gives you an idea when I bought it. So the Carter years I worked real estate in the Carter years, which was my first commercial note was 19.
Yeah.
Adjustable.
Yeah.
At First Eastern Bank. What I have learned and try to teach my investors that I used to work with is that the rate is not important.
Great point.
It
Great point,
is
Mary.
as you stated, it is the cash flow and the entire portfolio of that unit that would make up its value. And if it fits an 18% interest, it's a good deal.
Right.
So when you get hung up on rates, I think you stop yourself from becoming that real estate
Right.
investor.
Right.
And I know many people could do that.
Yeah.
In my
Yeah. Rates, well, I've been saying rates are variable, but rates are but a variable, right? They are one factor in this equation.
right.
Yes.
They're one factor.
Yep. 19% interest rates, and you were able to make that work back
Actually,
then?
money, by
Yeah.
the way.
Yeah.
Okay, I had second on it, the first and second,
Yeah.
and it paid it with positive cash flow.
Yeah.
The numbers were good, they weren't great, but they were. Obviously, the bank agreed to them. So, and I continued doing that throughout the years until, this is funny, until it got to be in single digits. I stopped buying real estate. Because I bought all my real estate in double-digit rates. Now, I refinanced them. Granted, when I saw the rates coming down, pulled cash out, and did a lot of good things with that. But my point is, the rate today, over a 45-year career I have in investing, is great.
Yes. Yeah. That's a good point. Thank you for making that point. Right. That's the challenge of rates and where they are. Again, the notional rate, between 7 and 8% right now. It's a psychological barrier because for the last couple of years we've been used to seeing those 2.5% 30-year fixed rate mortgages on the residential side, 4% commercial rates. To go from 4%, it's not so much where we are, it's how quickly we got to where we are. And that's completely upended a lot of pieces. And it's going to create it's a shock wave, like I said, in 2025, when the people that bought that duplex at 4% has a rate adjust, and now they're staring, a much higher interest rate in the face. So I think there's going to be a lot of opportunities. I can say in the last 4 years, I work with more first-time investors in the last 4 years than I did in the 10 years before that combined. There's a lot of people I have one client that calls it the Facebook, Instagram, TikTok influence on real estate investing. It's a positive that there's more real estate investors, in my opinion. Just like the crew that's here this evening, rising tides raise all ships. So there's a lot of mentors, people to talk to, lean on within this room, especially for new investors or aspiring investors. But it's going to be a challenge when those folks bought in 2020, when anybody could have made money in real estate is faced with a rate adjustment or tough times. And what's going to happen is as those rates adjust, people are going to be getting their tax returns back this time of year saying, man, I've been doing this for the last 4 years and I made $1,200 on this rental. Landlording is a job. It is work. And they're going to say, I only made $1,200? And oh crap, my rate's going to adjust next year? What am I doing? Let's list this property for sale before I take too big of a haircut. So I think there's going to be a lot of opportunity looking ahead. So that's just, again, my opinion, looking down the road.
But if you're a true investor, when you have that situation in 2020 and you purchase that property at that rate, it's your job to manage that correctly over a period of the next 5 years, so that by the time you get to that adjustment and you have an estimation of where it might go, and it is a guess, but if you follow it, you can get pretty close, and you can adjust your interest rate to cover that, and you should be fine.
Yep. In fact, scrolling back up here, it kind of cut off a little bit. And again, it's not the clearest picture. This is what's called a stress test debt service ratio. So when I stress test a property, and that's something we started doing a lot of during COVID when rates were low, because we knew that rates were pretty bottom of the barrel at 4% on the commercial side. When we stress test a debt coverage ratio, I take 90% of your NOI. Okay, so I cut your NOI down, which again is after gross rents less vacancies, maintenance, and expenses. I take this number, so in that hypothetical of John's, it was 112,000. I would take that down to 101,000, and then I would take the debt service, if there's existing debt, I'm going to jack the rate up by 2% and say, now what's it look like? Okay, and no, you might not be a 120 at that case. Okay, but if it's above a 1.0, meaning break even, okay, I'm comfortable and you can be comfortable in that scenario. The challenge is, again, if you had a floating rate, okay, where your rate could adjust any time, again, a lot of big banks will do floating rate mortgages as well, usually tied to Wall Street Prime, okay, which again, right now is 8.5%. That's where you get burned pretty quick when your rates shoot up, okay? And again, that's what if you could see the chart for the Wall Street Journal Prime rate, rates were much, much higher back, in the Carter and Reagan administrations, back in the early 80s. The challenge is how quickly rates have shot up. If you looked at the graph of rates, especially whether it's Wall Street Prime rate or mortgage rates, when they shot up back in the 80s, it was kind of like this. Now we're looking at a rate of increase like this, almost straight up. That creates more challenges than just a high interest rate in and of itself. So again, the stress test, if you're above a 1.0, okay, you're still making money. You're still creating wealth, I should say. You might not be getting cash flow, but you're building equity and capital appreciation, okay? And depending on the investor, depending on your scenario, maybe that's all you're really looking for, okay? I work with investors that they don't care about cash flow. They might be investing primarily, actually, for tax advantages, okay? There's people that buy raw land and sit on it for capital appreciation purposes, but then they can also write stuff off against it. There's a lot of ways to leverage real estate to your advantage. A lot of ways to structure things too.
I think the two things that real estate investors, at least the ones that I talk to, oftentimes overlook is strategically having rent increases, even though residential markets will disagree with you as the renter. But you should be increasing your rents every year at least to the same pace of standard inflation. So like for an extreme example, our 42 unit, even if we did a $50 a month increase every year, that's $25,000
Jack.
a year in new revenue. That can help us keep up with rate adjustments.
Right.
But
Right.
the other thing too is if you've got multiple properties and you're not leveraging depreciation on your taxes, you're really missing out. This year alone, we were able to depreciate over $100,000 in our tax returns by depreciating our portfolio.
I agree.
And that just means that I can make $100,000 pre-tax and not have to worry about taxes on it because the government's tax code says that buildings depreciate. And so it's great. So there's definitely some really creative opportunities.
Yeah, and I kind of mentioned too that the real estate's one of the most tax advantaged industries in asset classes there is. You know, there's 1031 exchanges. I'm sure a lot of people in here have at least heard of 1031s. There's great tools, great resources, and I think there's been speakers on the 1031 exchanges as well. There's some local qualified intermediaries that can talk about that further.
I have a question. If your client happens to be one where they have an enormous income, such as, let's say they're making between $350,000 and $400,000 a year, and they're looking at a property, and the need is the negative, heavily negative.
Yeah, that's a great question.
What do you do with that?
Yeah. So again, DCR, so I mentioned earlier, I build my sandbox to fit you. I use the sandbox analogy, the residential side. If you don't fit in that sandbox, you just ain't playing in the sandbox. I'm going to build my sandbox to fit you. So you might not have the rent roll cash flow, but if you can more than adequately absorb that on a personal income, I can still work with that too, okay? Because maybe it is on a 1.05 DCR, not that 120, or maybe it's a 1-to-1, or maybe it is slightly negative. I've had instances where I've financed an acquisition of investment properties that were truly investment, but they bought them because it meant more to them because it was directly adjacent to an existing property, okay? I got farmland. I've paid more for farmland because it adjoined me, okay? It was worth more to me than anybody else, and I didn't want anybody else to have it because it butted my property. So I pay more for that property than anybody else would. Same concept can apply for rental properties. You know, if you have a half double and you want to buy, the other side comes up for sale, you'll pay more for that, and it might not cash flow by paying more for it, but you still want it. AJ.
Can you explain a little bit? So hard money lenders need 12 or 14%. They're lending 1-to-1 ratio. A bank's ratio is not 1-to-1.
Right. We look for that 1.20 debt coverage ratio.
So, meaning from the lending side, hard money lender has this much cash, he can lend this much money.
Right.
Off of his balance sheet.
Correct.
How does that look from a bank?
Yeah, so we can lend more than 1-to-1. Correct. Yeah, we have leverage funds.
How much do you go by?
That depends. I mean, it goes off of capital ratios for banks. I mean, there's a lot of accounting metrics that go in there. But on a high level, I mean, it's almost 10-to-1.
Another question. Sorry.
No, you're good. Yeah, you got lots of questions.
If you have at the lender you're going to borrow from, if a client has, let's say, $100,000 in a CD, and could you ask the bank to freeze that and use that as collateral for the investment property?
Yes.
Good.
Yep. So that's. I didn't really talk about that, but that's a great. I've done that even just recently, where I can lend against investment portfolios. I can lend against real estate equity. I can lend against liquid cash. If a lot of times, cash is always king. Once you put that cash into real estate or otherwise, you're one step removed from cash. Okay. Even stocks. You can buy stocks and say, well, I want to buy PP&L stock. Okay, which I could leverage, but you're one step removed from cash. You could put that money into a CD, okay, and then I could lend against that CD. The cash is still yours. I'm just locking it up, and then you'll earn interest.
So it can
Correct.
offset the interest to some degree.
Correct. So to use CD lending, that's a great segue to CD secured lending. $100,000 CD, and you want to buy a $100,000 rental property. You have the cash, okay, but maybe you say, you know what, I think interest rates are going to come down. Let's put that $100,000 into a CD, maybe yielding 5%. And then I typically lend at 2% above the CD rate, okay? So I'm going to turn around and give you a 7% mortgage at 7% on $100,000. But keep in mind, you still have your $100,000 over here earning 5%. Your net rate's 2%. You're getting a 2% mortgage. Okay, all intents and purposes. And the money's yours. And then at some point in time down the road, when rates come down, mortgage rates come down, refinance your 100 grand, get your CD back, it's your money, plus the 5% interest, okay? And then the house is held as collateral, okay? And then you can use that $100,000 CD for the next one. I can use the $100,000 CD as your 20% equity injection. You can buy a $500,000 property and I hold that $100,000 CD and have a $400,000 mortgage.
I have a question. So
Yeah, go ahead.
With that CD, 100,000 in CD, is that you 100% funded or is it?
Yep, I lend dollar for dollar against liquid collateral. Yep, for CDs, savings accounts, it's dollar for dollar. Now things like stocks, mutual funds, bonds and stuff, I can't lend dollar for dollar because there's market volatility. So we typically lend up to 75% on that.
Stock crashes, do you call a loan?
We can't, if there's a collateral shortfall, we can call you up and say, hey, you need to put more on deposit or you got to pay this loan down. Yeah. Yeah, so if you had something secured by Enron stock and then all of a sudden it, collapses, I might be calling the loan or we're looking for alternate, collateral.
So if I was gonna buy a $100,000 property at a conventional 20% down, is there any reason why I wouldn't just go and buy a $20,000 CD?
You could. Now, if we were going to do that, Mike, we'd be looking at, say, a $100,000 loan, secured, $80,000 secured by the property, $20,000 by the CD. We're still going to be looking at this debt coverage ratio. Okay, so I still want to. Yeah, but that's a good way to preserve your cash because then, again, every month you're going to make your mortgage payment, you're building that equity, and I can always release that $20,000 incrementally. Now, we try not just because of the logistics. We don't want to do that every month. Say, well, I paid my $600 payment and built $300 of equity. Here's $300 of your CD back.
Why wouldn't I do that though? Because my $20,000 is locked up either way. Either I give it to you,
Or it's less liquid. Yeah.
We're just making money off of it, right? At that point.
right?
Yeah.
So,
Yeah. Right now, it makes more sense right now
Right.
because interest rates are, when the CD rates were 0.05%, it wouldn't make sense because you're better off paying down and putting that towards a mortgage, even when it was at 4%, because that's a guaranteed 4% return.
what about your college kids? Got any questions? Wow.
I must have answered them all.
Very good presenter.
Yeah.
I guess I have one question.
Yeah.
So obviously, as a first-time investment property, you don't have anything to collateralize with.
Mhm.
So is there any other way outside of just the casual 20% down? I know there's some conventionals that are.
Yeah, conventional. So the best way, and I know Jeremiah mentioned house hacking earlier. So that falls outside the parameters of typical conventional commercial lending, but conventional lending, you can get an FHA loan, you can get USDA, VA loans for veterans with little to no money down. I encourage you to talk to a residential lender or some of the realtors in the room that can talk about some of those conventional financing options. FHA, 3.5% down, up to a 4-unit property. There's a lot of options available to you for house hackers, especially. That's a great way to get started too, especially as a young person.
How many years you have to live in a house hack before you can move out?
That's going to fall more on the conventional side, residential side. I think it's just 1 year to live in it. But the other factor you want to keep in mind is if you're going to be living and then kind of selling the properties and trying to roll capital gains forward. If you want to avoid capital gains, again, not a CPA, not an attorney, sure as hell don't want to be. But to that end, if you live in a property 3 out of 5 years, at least at present, 3 out of 5 years as your primary residence, you are excluded from capital gains up to $500,000.
2 out of 5 years.
Is it 2 out of 5 years? Yeah.
I think it's 3.
Is it 3? I think it's 3.
We'll split the 2.5 years. We'll split the difference. Yeah.
It's actually a pretty great deal. I didn't know that.
Yeah.
VA though, VA is only 1 year. I mean, they technically, that's not.
Yeah, VA loans, for any veterans, VA loan eligibility is huge. Because VA loans are also nice. Again, I'm talking outside of my expertise here, but VA loans are also assumable, which is a big selling point for houses. Yes. VA loans are assumable. Big selling point right now, because again, interest rate environment 7% on the residential side. If you have a 4% VA loan, who wouldn't want to assume that? So, but again, as Mary said, there's some caveats to
You
that.
can assume the loan, either a non-veteran can assume the loan, but the liability is still applies with the veteran.
Yeah.
So I always advise the veteran not to allow the assumability of a non-veteran.
Yeah.
That way you can transfer the liability back to the other person.
Non-veteran can assume a VA loan?
That I can't speak to. I don't know enough about the residential piece.
Did you say that a non-vet can assume a vet?
Yeah, a non-veteran can assume a loan, but he doesn't assume the liability. The current
Right.
veteran does keep the liability, so if he defaults,
That's
it
almost
goes-
like lending out
he's
your equity to
responsible.
help somebody.
But you,
Yeah.
again, not a smart thing to do, but you transfer the liability to a veteran and you maintain your eligibility all over again. You can use that 10 times as long as you keep bringing it back to you, and that's not a
Yeah.
problem. It's a pretty nice piece of change, because I know a lot of new time, they're veterans obviously, that came in and said, I wanna buy a duplex, it's 150,000, and I'm gonna live on one side.
Yeah.
Fine, you can live in that one side 1 year, and then you can turn around, and that's a 30-year amortization, so much lower. You keep that and you move on to the next double, and I had a veteran who did it 7 times, kept all of his property, his portfolios, then started to build a whole lot of equity, and then took that equity and started purchasing other stuff.
Yeah.
So a smart young veteran would go in and say, you know, I'm not just gonna blow my money away, I'm gonna build a portfolio.
Yeah.
And that portfolio then skyrockets. In 5 to 10 years, he's got a huge portfolio
Yeah.
with no money and no skin in the game.
Yeah.
At maybe just closing costs.
Yep. You opened up two thoughts there for me, Mary. One, the 20-year versus 30-year. I mentioned those were one of the key differences between residential and commercial. But a lot of times people say to me, well, I want a 30-year mortgage. I want a 30-year term for my commercial mortgage. If it's going to take, at least for our local environment, if it's going to take you a 30-year term, the cash flow of property to 1.20, you're probably not getting a great deal on it. Okay, quite frankly. Again, 20 years strikes a very healthy balance between cash flow, equity built, and capital appreciation. Because again, 20 years, after 5, if you have a 30-year mortgage after 5 years, I mean, if anybody has a 30-year residential mortgage and you're 5, 6, 7 years into it, you know what I'm talking about. You've paid down very darn little. Yep, very little. But if you have a 20-year mortgage and you're 5 years in, you've paid down a reasonable amount. Okay.
You can schedule that 30-year loan though by yourself to make it pay
Right,
15 years.
right,
without-
right.
without-
Yep, so I've had folks that, they buy a property and say, well, I know the cash flow is good. I want to pay this off and give me a 10-year term.
Yeah.
Well, maybe I put a 10-year term into my cash flow here and it doesn't look so, it's not a 120, okay? Because again, I have to project and we have to rely on some level of projections. Let's set it up for a 20-year. If you want to pay it off in 10, by all means, you can. I'm not going to penalize you for being wise, prudent, with your money and your investments. Let's set up for 20 years. Pay it off in 10 if you want. Just make double payments. The number of people that do that, by the way, is very slim, and when I have that conversation with them, because it's very difficult to maintain that discipline. But I tell them to do that because, well, what happens if you need a new roof?
Or
Okay.
you lose your job and can't fluff it or anything.
Right.
Yeah.
So let's set you up with a 20, because if I set you with a 10-year term right off the get-go and you have a payment that's this big, you always have a payment that's this big. If I give you a 20-year term, your mandated payments are this big, and if you want to make them this big, by all means, go ahead and do it. But it gives you flexibility. We're taking a trip this week, I don't have to make this big payment. I don't have to make up this much of a payment. So give you a little flexibility.
I think the secret behind a successful investor has a lot to do with managing exactly what you're talking about. I think you can do all the above, which includes paying it off at half the time, without an effort, without a lot of money put into it, because I think you can even set that up for them. And you turn around and paying it off in 5 years or 10 years may not be the goal that they set. Maybe the goal that they set might be by 50, I want to be debt free, and
Right.
you don't want to do this or that and other. So if they start programming it in a way that you need to have the tax, as John said, the tax benefits to it. You don't want to pay it off right away,
Right,
because that might be a real problem.
right.
So I think sometimes you have to look at that 10, 15, and 20-year plan and how that's going to play out. If you do 15 properties to do that, or 10 properties to do that,
Yeah.
you manage them accordingly.
Building and scaling a portfolio requires
Yeah.
a goal-minded
Yeah,
mindset. It also requires, leveraging, strategy. And that strategy is going to be developed by leveraging, those resources. Again, I'm just one piece of it. I'm the financing piece. And yes, I work with a number of investors and, many aspects of REI, but consult your attorney, consult your accountant and say, hey, here's what I'm thinking. Is this going to behoove me tax-wise? Or is this really going to, stiff me in the end when I get next year's tax bill, or when I decide to retire? Is paying debt off early? Consult all those numbers. I mean, people look at all sorts of metrics. I mean, I get investors come up and say, well, the cash flow on this thing's $200 a door, and that's the sole metric they're looking at, is cash flow per door. Again, I don't care about cash flow per door either. Okay, if I say I have a 4-unit that's cash flowing $200 per door, or a duplex is $200 per door, which one's the better investment? Somebody who doesn't understand might say the 4-unit, that's $800 a month versus $400 a month. What if I told you that 4-unit was in Lewisburg and it was $600,000, and the duplex was in Bloomsburg and it was only $120,000? Now, which is the better deal? From a cash-on-cash return, the duplex at 120 is. Same. To use, again, sorry to pick on Shamokin here, Justin, but if I said $200 a door cash flow in Shamokin, that's probably par for the course easily. Okay, but again, $200 cash flow per door in Lewisburg, where a duplex might be $250,000, your cash-on-cash return is a lot smaller in Lewisburg compared to Shamokin. So again, that's where DCR kind of takes those factors and throws it out the window. Okay, I don't care about cash flow per door if I'm looking at a DCR.
I think the single-family dwelling shouldn't be ignored as an investment, because I happen to favor those and have quite a few of the single-family, and the reason behind that is twofold. One, easy to liquidate,
Yes.
and two, college kids' tuition funding still. So
Yeah.
I would sell one every time one of my kids needed to
Yeah.
go to school. So that was the reason behind the single-family. I wouldn't recommend a full portfolio, although I
No, that healthy-
I have a client who did that.
Yeah, a healthy mix of unit mixes.
Yeah, unit mixes.
Yep.
He said to me this, he said, I only make $100 per house. Doesn't sound like a lot of money. He said, but I own 100 of them.
Yeah.
And he did, all over the
Yeah.
United States. He preferred single family. Well, that's all well and good for him, but that was his take on it, but I think mixed use is what you're looking for.
Yeah. I mean, again, I can do single families. Again, I'll use that to segue into another point here. I can finance single families, 42-unit properties, mixed use, you name it, I can do it. I can finance in your individual name. I can finance under LLCs, corporations. The residential piece, you can buy investment properties on the residential side, by the way. As I mentioned, FHA for first, house hackers. You can buy, it can be non-owner occupied, and you can still use a residential investment property loan. You can get a 30-year fixed rate if you want, and buy an investment property non-owner occupied. But it has to be in your individual name. Okay? No LLCs, you don't get that extra layer of protection for liability. Typically, it's going to be a higher rate than the conventional owner-occupied fixed rates. Okay? It's also only 1 to 4 family units. I can do 5+ units. I can finance under LLCs, you name it. There's pros and cons. As you were saying, Mary, single families, I tell folks, if you're not house hacking a multi-unit for a first-time investment, single families are nice to dip your toe in the water, okay, because you can easily liquidate it, And single families tend to be more capital appreciation centric as well. So you're always going to get the equity creation regardless of your property when you're using leverage, but you're going to get more capital appreciation. Now your cash flow might stink, $100 per door, for instance, but it's still positive cash flow. It's also very easy to liquidate. If you have a 5-unit investment property, you bought it in 2020 and here it is, or you bought it in 2022 and 2 years later you say, this ain't working out, I want to sell it. Who is your likely pool of buyers for a 5-unit property? Other investors who are going to look at that property transaction and say, John bought this 2 years ago and paid $200,000 for it, and now he's trying to sell it. I'm going to offer him $205,000. He'll take it because they see blood in the water. That's how we as real estate investors work, right? It's when there's chaos, there's opportunity. Death, divorce, and desperation, destitution. Those are the D's of real estate.
Desperation.
Yeah. So when it comes to single families, though, who is your likely pool of buyers? Could be your tenant that's in the property. Could be another real estate investor. Could be a first-time home buyer. You got a lot bigger pool of prospective buyers there. The challenge is, I will say, in this rate environment, again, as I said earlier, I can establish kind of rules of thumb. In this rate environment, with rates where they are, it's hard to buy a single-family property in our footprint and cash flow anywhere near to a 120, let alone a 1-to-1 in this rate environment. But again, there are some good options
I
there.
think you're looking at those that are under 150.
Yep, has to be. I would say right now probably 120 or less.
Yeah, could be.
And then it'd be tough to leverage.
Sure.
You know, I can't buy $120,000 single family property, rent it for market rents in our market area, and leverage a $120,000 loan against it and cash flow it.
Yeah, so circling back to FHA, I know one of the requirements is to live in the property for 1 year.
Mm-hmm.
From the bank's perspective, who is monitoring that?
Nobody.
Great question that I don't know the answer to.
They don't.
So,
Yeah.
so I've heard of
Nobody is right.
So I've heard of the
monitors
loophole
stuff.
being,
I can tell you
you know,
that,
you
but
take the FHA, you state your address at that property,
Mhm.
live somewhere else, you have then more cash flow units.
Yeah.
What would be the legality on that? Could the bank then seize your loan? How would that work if that was actually?
Yeah.
Hypothetically.
Hypothetically, yeah. I'll be honest, I don't know enough about the consumer, the FHA side, the residential side, but, you know,
the way they monitor that is if they do find it, it's the mill, your address.
yeah. Yes, they do have to monitor that. So, I mean, if you go out and buy another property, then you list, you know,
You change your address.
yeah. And your address is reported in more spots than anything. But if you go someplace else and you change your driver's license, I mean, when I pull a credit report, I can see, you know, all the addresses you've ever had tied to your name. You know, so if you had an apartment in college and you're 35 and I pull your credit report, I'm still going to see that.
And FHA does have a program that is no money down.
Yeah.
I think they just came out with it.
They did. They did. Again, I don't know a lot about the FHA piece because that falls under the residential, the consumer side of things. But reach out to me, grab my card, shoot me an email, and I'll get you in touch with somebody that can probably answer that question for you. Yeah. Tom?
Yeah, you said that you could use someone else's equity.
Yeah.
Can you use another LLC's equity?
You could. I mean, as long as they're willing to pledge it, I can leverage whatever. As long as they're going to sign. So, again, going back to the example where I say, you know, Jeremiah, you seem like a heck of a good guy. Let me pledge my equity in my farm. You know, I'm going to sign the mortgage. There's all the documents in a loan packet are important. But the two most important are the mortgage and the note. Okay, the note, the promissory note, that's your promise to repay the debt. That's what locks you up. The mortgage is what throws away the key. That's encumbering the asset to the bank. Okay, it's what says that if you go in the default, I can step in and take that asset. Okay, I always put it, you know, it's your common sense document. It's 15 pages long. You're going to pay your taxes. You're going to pay your insurance. Don't store hazardous waste on the property. And as long as you pay, you can stay. If you don't, you got to go. Okay, what it simply says. If it's another LLC or another individual signing that mortgage, I'm pledging my asset that if you don't make that note, I got to go. Okay, it's my asset at risk. So yeah, it can be so you can have another rental property owned by another LLC. It could be, you know, John pledging equity in one of his LLC's assets for time to buy a property.
This might be more of a legal question, but do people do that? Does that break the corporate veil?
It does not, because it's all still. I mean, it can be. Again, I'm not a CPA or an attorney, but there might be tax implications. There could be legal applications. I don't know the answer to that. But depending on how that arrangement is made, I don't see any reason why. It could be a loan to others, you know, could be held on a balance sheet as a loan to another institution. So it depends on what the arrangement is between. I mean, typically, you know, in an arm's length transaction, I'm not going to pledge my asset for you without some type of return to me, right? So I might say, Tom, I'll put up, you know, kind of like a private lender or hard money lender. I might say, well, I'm going to put my asset up for you, but you're going to give me some type of retainer for that. In which case, you know, there's a economic transaction taking
Are
place.
there standards for that? Like, we were doing that one deal that was they wanted to seller finance it for 0% interest, but then there was an implication that, well, they're going to impute interest.
Correct. There's an imputed interest rate by the IRS that changes from year to year.
Would that be a potential issue for, like, pledging, basically? Does there
To
have
my
to be
knowledge,
any
no.
change?
Yeah,
Is
to
there-
my knowledge, no. There's not an imputed interest rate on that. There doesn't have to be it could just be, Mike, you seem like a hell of a guy. You know, let me put mine up.
Those guys.
Yeah, let me put up my collateral, you know, for you. You know, as your equity injection. But to my knowledge, no. There's no tax or legal implications there. But I could be wrong. Could be mistaken there. Other questions? Room's kind of quiet. there's no other questions, my contact info is here again. I also have some cards up there on the tables. Also some giveaways, some chip clips, pens, Post-it notes. Help yourself. The more you take, the less I got to take home. But all my contact info is here. My office number, my cell number, my email address. Call, text, email me. Reach me anytime. Like I said, if you got a prospective property you're looking at, I could pull up that spreadsheet. Or again, you can pull up the spreadsheet and I'll walk through it with you. It's very simplistic once you get the understanding, you know, the hang of it. It's pretty easy to walk through. But happy to answer any and all questions. So, I'll be hanging around a little while. So.